Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, we're going to talk about bonds being interesting again. We're going to talk about, why they're interesting, the 100-year storm that revealed itself in 2022, kind of the nature of the fixed income landscape, how we think about it, and then common errors we see. Justin, we're recording this in early March, so I have the Olympics on my mind. So my surprise segment is this. Which Olympics is better, summer or winter? And then I would love for you to also answer for the Winter Olympics specifically, because that's what's been fresh on our minds. What is the most overrated and underrated sport in the Olympics?
Wow, that's a great question, Jared. I'm just going to go rapid fire here. I'm going to pick Summer Olympics as being better, and I'm not super passionate about that answer. I'm going to just give it a slight edge. So let's go Summer Olympics. Now, Winter Olympics. I'm going to say this. I don't have a ton of interest in skiing as a sport. So maybe let me caveat this, the most underrated in terms of this is one of the craziest things that human beings, that athletes are doing at a high level. When you see speed skiing and they are just reaching speeds on the slopes that are terrifying, that blows my mind. I cannot believe a couple things. Who figured out that we can just go down a mountain on sticks like that? And then we somehow morph that into millions of people every year love it and do it. That's amazing. Which, hey, skiing is awesome. It's very fun. But I think that's one of the craziest things that human beings do. And I like it, but it's crazy.
It is. So you said sufficiently underrated almost is even though that's one of the highlights. What's an overrated one?
What are we doing with curling? Let's call a spade a spade. Get back to the office, leave the Olympics, curling athletes. You're not athletes. Leave the Olympics, go back to work. What are we doing? Throwing a little disc on some made up ice and then shimmying the ice for the disc to go? What are we doing here? And that's a reason why I would slightly give the edge to Summer Olympics. A bunch of these sports just probably shouldn't exist. And, I don't know.
I think curling is captivating. It's more of just fascinating. How does somebody come to do this? Right? If I had a wager with somebody and they said, hey, your kid has to be an Olympian, I would pick a niche sport like that, where the total addressable market of people participating in that sport is very few. I've never been at a school or even heard of a school that has a curling team. So it's just fascinating. How do you even get into curling, and how do you get to that high of a level?
I will say this might be a crazy hot take. And, I don't have it perfect. We've talked on the podcast before that youth sports are just totally insane. And, the short version of that is if you are spending just endless hours and your family doesn't have dinners at home together, on a nightly basis, your family isn't able to go on vacations often because every free moment is given to little Johnny's travel baseball team. That's the dumbest thing in the world. So with curling, there is an element where it kind of highlights that, what are we doing? And then you realize, yeah, it's also stupid if you sacrifice every free moment ever, because guess what? When Johnny's 19, if things go extraordinarily well, he's going to be putzing around in the minor leagues, which is a stupid idea. And he needs to get focused on life and quit, jacking around with this stupid sport. Now, again, I'm going to freely admit that I don't have the right answer. And as our kids get older, they are also very involved in activities. And so the ideal is you want them to learn the life lessons that sports can teach that are very valuable, but you also don't want them to wake up at 19, 20, 21 and think that life revolves around basketball, golf, baseball, or curling.
Awesome. And with that, let's talk about bonds. Okay. So it's funny because, Justin, I feel like I'd be curious if this is your experience as well, but most of my professional career, nobody has cared about bonds. And if they have cared about bonds, it's been one question: why on earth do we even own these things?
Yep.
Has your experience been similar?
Very similar. We are talking about just an incredibly low interest rate environment, which means that the income produced by bonds is far lower than the kind of 50-year historical average. And then we just had a 100-year storm back a few years ago. And so could not agree more. Bonds have been terrible.
But also too, right? Like bonds have been terrible, and we'll talk about the numbers, but bonds have been terrible and equities have been on a bear market tear, right? Like it's not just like I don't know. I feel like more people would
Or
be
bull
yeah,
market. Yeah.
yeah, bull market tear. That's what I meant. Yeah. They've been on a bull market tear, right? They've just performed so well that like having risk management hasn't even really benefited you. And the crashes we've gotten since 2010 have been very swift in nature. It was the COVID crash. It was Liberation Day, right? And those were, fast, severe, and back to all-time highs very quickly.
Great point. And it makes people forget that the reason why bonds are an incredibly important part of a portfolio, Jared, we did a podcast maybe a year ago on this idea that no one actually gets to invest with purely a North Star of how do I get the highest return? Like, you don't get to invest that way. If you're a family and you're retiring, you do not get to allocate 100% of your money to where can I make the most money. You literally have to be mindful of, hey, how do I navigate the fact that I'm 62 and I'm going to spend $21,000 next month? Therefore, I better have the cash flow in my portfolio that will make that possible. And then we also took that idea up to massive entities, whether it's pension funds, whether it's university endowments. They also have short-term obligations, which mean that they need to do what you like to call duration matching. And so you have to provide current or a proper amount of liquidity, cash flow, income in a portfolio, whether you are an individual family or whether you are a massive entity allocating billions of dollars.
Yeah, there's a term in our industry, perpetual capital, right? Like we just we don't even need this money, but like that defeats the purpose of investing, right? Like if you're just going to invest indefinitely and never spend it, what are we even doing?
The problem with that idea is almost no one actually gets to invest that way. Like even a family office who's allocating hundreds of millions or billions of dollars, they still have to have some element of duration matching.
Right. And then these Ivy Leagues selling some of their privates at a discount because they need liquidity. Even these Ivy Leagues. Okay, so just for context of just how bad it's been and why we haven't been talking about bonds. So Fed funds rate is a really good proxy. It's kind of the baseline interest rate that all other interest rates kind of build themselves off of. We're not going to dive too deeply into the mechanics there, but Fed funds rate. So over the last 70 years, it's been about 4.6%. So most of our professional careers, so from 2009 to 2021, it averaged 0.52%. And it never got above 2.5%. So rates were insanely low for an insanely long period of time. But if you think about, right, 2010s was a time marked by really mild inflation. But with base rates that low, like best case scenario, your real return, so your return after inflation was flat. Honestly, you probably lost a little bit of money after inflation, right? If you get, if you get a 3% interest rate, that's probably, depending on how you're invested, it's probably subject to some amount of tax if it's in a brokerage account. And so your after-tax yield is lower than that. And if inflation is, 2.5%, you're not making any money after inflation. So for a 10-year period, you were probably, best case scenario, keeping pace with inflation, but probably not. But then 2022 rolled around and, rates rose essentially from zero. And for rates, we're talking about Fed funds, and everything is pegged, generally, oversimplistically pegged to that rate. And so it went from 0 to 5.5% in a 12-month period, which, to be clear, that's part of the reason they're interesting again. That's exciting, right? Like, okay, I was functionally getting nothing, and now, rates have moved up, so I can get something. The problem is it's terrible for current bonds, right? Because the price of my bonds has to adjust to the new reality, right? If my bonds pay 2% and I can get other bonds in the market for 5%, I have to lower the price of my bonds to match that 5%, right? So we, basically bonds got more compelling, but simultaneously they bore the brunt and had a brutal correction over that 2022 period. Justin, is there anything you remember about that period that was like particularly interesting or fascinating, or at the time were you excited or discouraged, or did we get lots of questions from clients about bonds?
Certainly did. And, Jared, it obviously helped that we were very mindful and careful to be just hawks with the duration in the fixed income part of our portfolios. And so, quick camp out there. If it's 2021 and you own a 30-year bond, there is an enormous amount of interest rate risk because you have a very, very long-term bond. If you own a 2-year bond and interest rates explode, well, the face value of that bond is in big trouble, but you could just wait until it matures, right? And get your principal back and then reallocate it at higher rates. And so the biggest thing that I, think about with 2022 is how much exposure do you have with long-term bonds and intermediate term bonds?
Yeah. So just like to put some numbers on this, because it was ugly, and I think it still is ugly depending on the type of the part of the bond market you're looking at. So U.S. Treasuries, Aswap Damodaran from NYU, he publishes annual returns by asset class. And so it goes back about 100 years. U.S. Treasury bonds, which is intermediate, so, not short term, not long term. Treasury bonds had their worst year annual return ever. They were down 17.8% in 2022. That's like stock market volatility right there. Worst return ever, right? So we just had our 2008 in bonds and nobody talked about it.
And I mean, Jared, I want to repeat, you just said we just had our 2008 in bonds. So I think it's very important for listeners. The 2022 bond, U.S. Treasury bonds were down 17.8%. That is like 2008, 1929, all rolled into one. Legitimately the worst return ever.
Yeah. Corporate bonds, second worst return ever. The only year that was worse was 1931. And we had just a little bit going on in the Great Depression, I would say. And those were down, 15%. And again, Treasury bonds are functionally the risk-free asset, and corporate bonds have some amount of credit. So, so it's not exactly apples to apples, but two of the larger, more important bond markets having, worst year ever and the second worst year ever tells you something about just how bad it was. I think it's so important. You talked about this idea of duration, right? Like the longer term your bonds are, the longer duration. So a 30-year bond, for example, the interest rate risk is material, right? And so, TLT, which is iShares 20-year bond fund, it is still 37. We're recording this in March of 2026. It is still about 38% off of its all-time highs, right? And it's just like, and again, people perceive bonds as safe. And again, those are treasury bonds. So it doesn't really have the credit risk that those bonds do. But that, we'll talk about this here in a minute. But like, it's why it's so important why you think about what bonds do you own and why do you own bonds? Because some bonds still haven't recovered, right? That was in 2022. And we're talking almost 4 years later. And, those bonds are still meaningfully underwater. Justin, I think before, so we'll talk about how I don't want to spend and bore our listeners too much, but I do think it's important we just highlight the different, because like when we say bonds, it means a bunch of different things, and fixed income markets are huge. So I just want to briefly go through all of them and but then also talk about how we think about them. Anything else before, kind of how we got here and why bonds are interesting again, before we start talking about what do we even mean by bonds?
It's really critical because when you're investing capital, it's obviously you're wanting to look at your different investment options and you're wanting to see how did they perform? What is the 1-year return? What is the 3, 5, 10-year return? And when you're looking at bonds, you're going to look at a 3, 5-year return and you're going to see this disaster. And it's important to kind of right size this and understand, hey, this is a terrible kind of 4 or 5-year window. And it is an absolutely historic, infamous 5-year window. And so you have to be able to kind of right size, hey, I know this happened, but what is the probability of this happening again? If the federal funds rate went from near zero to 5.5%, and that caused this once in 100-year disaster, okay, what are the odds that that happens again?
Did we go from 5 to 10?
Yeah.
Right. And again, like I think structuring your bond portfolio with the black swan event in mind is a very helpful exercise.
It is.
But with back-to-back black swan events, we're dealing with a probability that's probably non-helpful.
I think it's important to draw a comparison. If you put yourself in 2011 and you're starting to see, hey, stock returns are looking better, right? We're having some periods where it's not down 40%, but it's 2011. So what if you look at that 3-year graph, the 5-year graph, and you're like, oh my gosh, the S&P 500 is still in, look at how disastrous this is. What if this happens in my next 3 years? And obviously Well, you're paying such a lower price for the earnings at that point that the odds of that happening again are lower. But what I'm trying to say is it's like 10 degrees more exaggerated with bonds. Because, yeah, when a stock market crash happens, it's still possible that you see more downward movement, over the next 3 to 5 years. That dynamic is not close to the reality in bonds. Is it possible that bonds are in trouble in the coming years? Yes, it's absolutely possible. But the odds of what happened in 22 happening again is like infinitely lower than even that stock example repeating itself.
Exactly. So let's chat just briefly about kind of because we use bonds loosely and all those things have different kind of underlying components and different risk factors. So I'll just go, I'll be brief with this, but treasuries default, right? So it's a risk-free, and I'm using air quotes for those of you not watching. It's kind of the baseline rates for all other fixed income rates. The issuer of the debt is the federal government. One nuance here about treasuries, it's confusing because they're issued by the federal government and are exempt from state income taxes, but subject to federal income taxes. I feel like it would be intuitively, it makes sense. Hey, if the feds issue it, exempt from Fed. But
Right.
okay, investment grade corporates, right? And these are all, if you just buy a basic ag bond fund, you will see all of these inside of that. So investment grade corporate, higher yield than treasuries generally because they have credit risk, right? So we can debate the merits of the U.S. defaulting, but the probability is higher that a tech company defaults, right? And so there's an embedded risk. There's not just a interest rate risk that I bear, but it's credit risk. Okay, what is the probability that this company stays solvent long enough for me to get my money? So generally, there's a spread, meaning I have to get more yield in investment grade corporates. But that spread, the additional interest I'm earning for taking credit risk varies over time in an economic environment. High yield, as otherwise known as junk bonds. So, investment grade corporates, which is companies like Apple, Walmart with strong balance sheets, high yield is more credit risk, right? So it's companies that maybe some oil and maybe some E&P companies, right? That have levered up to acquire some assets, right? Lower quality companies, higher rates, higher average credit risk. And again, there's an additional spread, right? Because there's higher credit risk. So you should be getting compensated more. But again, it's interesting because the spread, meaning the difference between these rates, ebbs and flows over time. Municipals, so it's confusing because these are bonds issued by municipalities and states. And, kind of getting back to the confusion, they're exempt from federal taxes, but they're taxed at the, state income tax level. And I know for our Texas listeners, that's not applicable. Interesting thing to know about municipals, there's always, the yields are generally lower. So you need to do a tax equivalent yield. So what that means is treasuries are paying 4%, munis are paying 3%. And, that 4% yield in treasuries is actually subject to a 37% tax bracket if you're in the highest tax bracket. So the actual after-tax yield is 2.5. But if I'm getting a muni paying 3%, I get that 3% don't pay any state income tax or a federal income tax.
And the inverse is true. If you have a very, very low income taxable year, then you may not need to worry about saving on income tax, and the tax equivalent yield is going to be different.
And those move over time, right? So it's not as simple as, hey, I'm just going to set it and forget it. Sometimes, depending on the way the yield curve is moving, the spreads between these, the answer could be one today and another one 2 years from now as your income tax situation changes as the rates and the curves change. We'll talk about securitized credit. So this, I feel like 2008, you use the word securitized and everybody's red flag.
Scary.
So it's a pool of debt-like instruments, right? So hypothetically, it should be lower risk, right? The problem is with 2008, you had synthetic CDOs and derivatives of derivatives, and there was a crazy amount of leverage in the system. But these are actually a big part of the fixed income market. CLOs, which are collateralized debt loan obligations, which are pools of loans. And one of the interesting things about them is their floating rate, and mortgage-backed securities, which is pools of mortgages. So these kind of have been out of favor of since the great financial crisis, but they are a big part of credit markets, and philosophically can be lower risk than, say, being owning a single loan from an issuer or owning a single pool of mortgages or a single mortgage versus a pool. And then private credit is really, you're not going to find those in an ag fund, but I do think it's important we talk about it because they're all the rage today. So, post GFC, there's a lot of banking regulation. And so there's a lot of things that banks could or are interested in loaning to, but can't for whatever reason, or their risk profile and advertising there. So there's private pools of capital that loan money to private businesses for a multitude of different reasons. And, it's a growing part of the economy. And, these characteristics of private credit, they're often higher yielding, floating rate. They're pretty high on the terms of the, list of secured debtors, generally first or second liens, and they have a piece of collateral that is some subsegment of the business or the business itself. So, interesting part of the business. And then the other thing is convertibles. So they're bonds that have equity-like conversion properties. So that's, 10,000. Again, I could have made a podcast about each of those and talked to the nuance of that, but assumed our listeners know. Just kind of giving, I feel like that context is good before we give the landscape of how we think about fixed income. But before we dive into that, Justin, anything we missed?
Yeah, I think I love the overview you just gave. I think it's really helpful for our listeners. Think about the stock market. So if you have different investments in the stock market, a popular term is called a style box. So if I'm really doing an x-ray on someone's portfolio in the publicly traded stock market, I'm going to categorize how much exposure do you have in large companies? How much exposure do you have in small companies? So the size of the company, that's one metric. And then you could also look at, are they a value company? Are they growth? And you can begin to kind of categorize, where's my stock market exposure? And then you could do that for US stocks, international stocks. On the bond market, I think the most helpful way to approach this is two things: credit rating and duration. If you're watching this on YouTube, credit rating and duration. And so credit risk, really, really helpful. To have a quick example, pretend that you are lending money to the US government. Now pretend that you're lending money to Coca-Cola. Now let's go on the really extreme example. So a third one is you're lending money to Cousin Eddie. So we have the US government, we have Coca-Cola, and we have Cousin Eddie. Those have three very different credit ratings. The US government is very likely going to pay you back. Coca-Cola, definitely likely to pay you back, but in a real sense, it is more risky than the US government. Cousin Eddie, very risky. We don't know if Cousin Eddie is going to pay us back. Now let's apply that second element of evaluating bond risk, and that is duration. Are you loaning money to the US government for 6 months? Coca-Cola for 6 months, Cousin Eddie for 6 months. Now pretend that you're loaning money for 26 years. Those are very different risk profiles. I think Coca-Cola is, probably a good company for the next few years. Are they going to be good in 26 years? Tough to say. So that changes the risk profile the longer you go out. And so just kind of a quick overview of some different comparisons with credit rating and duration.
I want to start an ETF that is just like the worst, highest yield bond and make the ticker CUZ. So it's like loaning to an unreliable relative, where the yield is like 20%, but the default rate is something crazy high. We may have just come up with a new investment idea.
Which is also just fascinating. And private credit is really interesting because there could be a massive spectrum of what that means.
Yeah, and how much underlying diversification does the fund have exposure to? And the other thing we didn't talk about with private credit is because it's private, the fund structure, it's like there's not also ample liquidity, right? It's an interval fund structure where you can redeem on a quarterly, and it's prorated up to a certain percentage amount. So not as liquid. So your money's kind of locked up. There's a liquidity component there. So Justin, how would you say, okay, because I love the framework of, thinking about duration and default. How would you summarize, and I think we've kind of touched on it in other episodes, but how do we think about fixed income investing generally?
We are largely wanting to see significant long-term appreciation by owning great businesses, owning great assets. Therefore, the purpose is very different within fixed income. And that is instead, we want reliability and we want cash flow when we need it. How would you define it?
Yeah. I would say, right, generally, is it Nick Murray who says you want to be an owner, not a loaner, right? Generally we want to be owners, not loaners. And if we think about optimizing investment, risk-adjusted investment returns, which really matter, there are some parts of the portfolio that optimize return, that are more return-centric, and some that are risk-centric. And we don't own bonds because they increase expected return. We own them as a source of funds when equity inevitably has down years. Drops in the equity market do not hurt long-term investors. They're part of investing, right? That's the cost of admission. That's why you have return over the risk-free rate. What hurts equity investors is selling stocks at the bottom, and it's when unrealized losses become realized losses, and you don't allow for their recovery. So, right, like I would say, like fixed income principally, you talk about this idea of like the war chest. So 5 years of living expenses with minimal exposure to volatility, right? And fixed income also, right? Like we looked at TLT and talked about their drawdown, but depending on where you are in terms of the credit risk curve and the duration, so yield, the time curve determines a lot of your volatility. But fixed income, if it's managed prudently, can create a sort of smoother ride, right? Where if I own all equity and equity's down 40%, that's really painful. If I'm 50-50 stock and bond and my bonds are flat and my equity's down 40%, my overall portfolio is only down 20%. So it really, really kind of makes the ride smoother. So I would say fixed income principally is, it just, I would say it's insurance, preventing us from being net sellers of equities in bear markets. And it reduces the standard deviation or the nerd speak of the average down year to kind of create a smoother ride along the way. So principally it's a risk reduction tool, not an investment optimization, not a return optimization tool.
Right. And I do think it's helpful to call out, if you really do have a bucket of money that you don't need for 20 years and you're absolutely not going to use it for 20 years, well, then don't get consumed with risk reduction methods in your portfolio allocation and instead own great assets that have the highest probability of returning great returns. But like we mentioned at the beginning, we work with a ton of clients who do not get to live in a scenario where they don't need any cash for 8 years or 18 years.
Yeah. Yeah. And like, again, I think a good kind of place to go next is like, okay, in light of how we think about this, we'll talk about common misconceptions, but like in light of our stated goal of what we want bonds to do, owning 20-year bonds that have had 10+% drawdowns since we've been over the last probably 15 years, that's a meaningful drawdown. And it doesn't really solve why I would want to invest in bonds in the first place, because it introduces a substantial amount of volatility. Probably same with high yield, right? Like it just introduces a level of volatility again, which isn't a bad thing, but it's not congruent with how we think about owning bonds. Justin, what are some common misconceptions or mistakes we see people make related to how they're thinking about fixed income or bonds? And we use those interchangeably.
I think there's a lot. I think one of the biggest ones that I want to talk through is this idea that like bonds as a catch-all term. And then that means, well, long-term bonds is the same as the index AGG. And that's the same as, maybe just US debt. And that's the same as short-term debt. And so I think there's just a lot of, hey, they're all the same, when in reality, I mean, you could say that cash is actually a bond. Like it's just a hyper, ultra short-term bond in many ways. And so it's kind of this combination of bonds means all of these things when those things are all very different.
Yeah. Yeah. I think like if you look at the like embedded, like if you own a passive bond fund, like it's composed of all of these things, and all of those things may or may not be congruent with how you think about fixed income. So like, I think, I guess private credit isn't in like an ag fund, but generally like ag has exposure to all of this, and the duration of close to 7 years. So it takes about 7 years for you to get your money back. And again, if my goal is to have fixed income as a source of funds in the event of an equity bear markets generally last less than 7 years. So that doesn't actually help me. So I think it's weird because we're very pro index investing, but when it comes to fixed income and how we think about it, I think blindly owning the index is actually a huge mistake. So, I think that's a big thing, is just kind of blindly owning the index and not duration matching, to use that verbiage again.
Love that. I mean, the reason you own bonds is because you need a war chest. You might have $5 million, but you're spending $150,000 a year. So you are taking money out of that every single year to pay for living expenses. And guess what? You can't put all 5 million in assets that hopefully appreciate. You need to have some exposure to assets that you can reasonably take. And so if the duration is 7, that's not workable for a war chest if that's your only position.
Yeah. Man, I think another interesting thing is like another common misconception we see people make is like the Vanguard passive own the market, which also inherently means like global diversification. Foreign bonds are really weird to me because, again, I don't necessarily think it's a terrible idea, but you have to make a decision of do I hedge the currency risk? Because you're introduced, like, if you think about why we own fixed income, it's preservation of purchasing power and equity market drawdown. If I own foreign bonds, I could actually get the yields right, but if I get the currency trade wrong and I don't hedge it, then all of the interest could be eaten up by being on the wrong part of a currency trade. And again, I don't think it's a terrible idea, but you're introducing another potential risk to the portfolio, which is currency risk. So why am I adding an additional risk? What is my purpose of bonds? And does adding foreign bonds help or deter me getting there? And I think it's another kind of interesting thing where it's like the taxation's not favorable and it adds currency risk unless you hedge that currency risk. So I think just generally foreign bonds are, I don't know, I probably lean no unless there's a really clear and compelling reason to make it yes. But I do see people that are kind of like, I own US stocks, international stocks. I own US bonds. I own international bonds. And it's interesting because, you know, global fixed income, US as a percentage of global fixed income is actually smaller than US equity is as a percentage of overall equity. So like foreign bonds are a huge, massive part of the market. But I think that narrative, oh, it's in the market, so I have to own it. It's just a very different way to think about things.
Really quick kind of call out there. We love this idea of like, what does it actually mean to be a passive or index investor? And the actual definition is, well, if you're truly index and passive, then you should probably have market capitalization weighted exposure to every asset under the sun, which would mean that you're going to own a ton of foreign credit. And I think it's just kind of a good reminder that, hey, we do love evidence-based, sound, passive investing, but in practice, no one is fully passive. No one is fully index, because if they were, they would have a 0.5% exposure to cryptocurrency. They would have a X% exposure to foreign bonds and so on and so forth. So just interesting. No one is actually purely passive or index.
Exactly. I think another kind of mistake we see people make is like the fixation on private credit. I think every few years our industry switches to like a hot product, whether it's like smart beta, option overlay, private credit. There's always what we would call investment du jour, right? There's like always like a new cool idea that somebody's selling. I don't think private credit fits in most investors' portfolios because, okay, you're introducing a multitude of risk, liquidity risk, right? So you have higher, so the credit risk is higher because you're loaning to small businesses that are outside banks. So they're going to be higher probability of default, but also liquidity risk, like in the probability of this money being there when I need it is also lower because private credit is typically more locked fund structure, right? Where I can't just buy and sell any given day.
Super simple example. There are private credit strategies where, you could lend money to a person who's flipping homes. That's a thing that exists. Well, guess what? When you lend money on middle of March this month, if you need it at the end of March, you can't get it, most likely. So you're right.
Yeah. And yeah, I think any other things, I have one more, but any other mistakes that you see people make?
I think that's pretty good.
I think the other big mistake is when doing due diligence on bonds, you look at price return versus total return. That's like another big one. It's like, oh, this bond, and again, even with a short-term bond fund, there will be some movement in price as rates move and ebb and flow. I would
have to look at total return.
Have to look at total return. It's like but if you think about the way that bonds pay returns, the primary mechanism for return in bonds is interest payments.
Right.
Right. And so to just look at the price return and say, hey, it went down 5%. No. Yeah, the price went down. But if you look at the total return, that's a meaningfully different. A good analog is it's like looking at US equity returns, but only looking at dividends.
Totally. Or Jared, I was going to give pick a laughably massive dividend, like a company that just pays a dividend that is 4 times the average of the S&P 500. Would you ever evaluate that stock performance and exclude their dividend? when they are outwardly all focused on having a massive dividend, that wouldn't make sense. You would have to look at the appreciation and the dividend.
Right. And again, like, I want to caveat this by saying these are mistakes we see people make based on our fixed income investing framework. If we were to hypothetically have a client that, 85-year-old terrified of the stock market and didn't want any stock market exposure, and you got a $5 million portfolio, we're going to need to put some of it in these other buckets because, we're going to have way more than 5 years of short-term liquidity. We're not saying these are inappropriate at all times, but just in light of how we think about fixed income, it's incongruent. So I think it's important for you to think about, how do I think about fixed income? And okay, in light of that, what part of the fixed income market do or don't I need exposure to and why? Cool. Awesome. Well, I think that's a good place to wrap it up. I mean, fixed income is fun again. It's good to talk about it. And I think rates are in a compelling spot, and real rates are positive, which is a great thing. And I think I'm excited for fixed income. I'm excited for the long-term outlay. But again, it gets back to the important idea of why do you own it? And in light of why do I own it? What do I believe about, all the ways to participate in owning it? Awesome. Well, we love hearing from our listeners. Always great. Always an engaged group with thoughtful questions. We love to hear them. Like, share, subscribe. We want to see this podcast continue to grow. Podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.